Vanguard now says that your retirement plan is wrong. Ouch. What gives? Recently, they came out with guidance that said retirees should consider a portfolio mix of 70% in bonds and only 30% in stocks. Using the TSP as an example, that's 70% in the F fund and only 30 in the CS&I. So what's going on that is causing them to become so conservative? In today's video, I'm going to help you understand this report from Vanguard and talk about what actions you might want to take in your own retirement plan. Then I think it'll be helpful for us to look at a real retirement plan together using this allocation Vanguard suggests so that you can see the potential long-term impact to a real federal retirement. So first, let's get into the report. Here we have the report from Vanguard, and I'll put the link in the description if you're interested in seeing it yourself, that discusses how one of their portfolios is going to expand their bond allocation specifically to 70% of the portfolio. In other words, they're going to hold 70% of that portfolio in bonds, which means only 30% of it is going to be in stocks. So that's a really conservative investment mix, especially when looking at the traditional 60-40, which has worked for so long for a lot of retirees. And to summarize the details, they're blaming it on valuations. In other words, the value of company stocks have grown so far that they no longer feel that there is that much more room for growth. Now I'm going to skip a little bit further down here, and I want to specifically show you this chart here that they have in their report. On the top here, they have a very vanilla, very simple, commonly known as a retirement portfolio of 60-40, with 60% in stocks, 40% in, they call it fixed income, but that's bonds. They do break it down into international US equities, US bonds, international bonds, but they don't go into the specific investments because obviously that'd be giving away what people pay for. And on the bottom, we have this new portfolio strategy that they are talking about in this report. So on the left-hand side, we have 30% in stocks, like they said, and 70% in bonds. I want you to pay attention here. When we're looking at US value factor, US growth factor, these two effectively are mimicking the S&P 500. So in other words, the TSPC fund. And look at how small of a percentage it is, not just in the overall portfolio, but in the total stock allocation. So it's 16% of the total 30% in stock. So very, very little allocation towards something like the TSPC fund. And the lesson to learn here is that we get really attached to investments that have done really well, like the S&P 500. And sometimes it's hard to walk away from those investments. But the truth is, not all of these investments will continue to be strong as time goes on. A little later in the video, I'm going to show you a chart that talks about the different cycles in the economy, and you'll see how this comes together. But Vanguard's not the only one. Let's look at some other ones here. Here we've got another article that is discussing and summarizing Vanguard's report here. Of course, just we already know that, recommending a 70% in bonds and 30% in stock. Goldman Sachs also discusses the S&P 500 having over 70% probability of underperforming bonds and in a 1 to 3 chance of lagging all the way through the next decade. Okay, folks, so we've got this also being the opinion of another analyst from a different firm. We've got Morgan Stanley also making a comment, S&P 500 over the next decade being essentially flat, or in some cases here, in a real basis, maybe negative. Real basis meaning after you factor inflation, and you might actually not even be keeping up. And again, going back to the reason the analysts are discussing this is we've got the PE ratio, which is one of the elements that we use in portfolio analysis. High 30s. In other words, when we've looked at history and the PE ratios have been higher than a specific amount, that has usually resulted in some sort of pullback in the markets, some sort of recessionary component of the economy overall. And so that's why they're looking at this and saying, we've got issues with tariffs, all kinds of instability around the world. We've got really high valuations where the price of stocks compared to the earnings that those companies are actually getting these days just doesn't make sense anymore. So there has to be some sort of price correction. That's what these guys are saying. So it's interesting to see that this is the position that a lot of Wall Street analysts are starting to take. Now, let me be the first to say, how many times has Wall Street been wrong? Hundreds, if not thousands. We do not pretend to forecast the economy, but because we are working on retirement plans, it's really important that we take some of these risks very seriously. That kind of volatility or lack of performance can really have an impact on a retirement plan, which I'll show you here a little bit later in this video. So let's break this down and look at this from a simpler angle. The economy essentially has different seasons. kind of like the weather. But unlike the weather, where we can pretty reliably know when we're going to change between one season to another, the economy is not quite that way. But there are still 4 seasons that we're working with, starting with a period that we've got high growth, like we've just come from. If you think about the last maybe 5-10 years, been a lot of growth. And for the most part, inflation has been pretty low. Okay, it wasn't until very recently, maybe a few years ago, that we've started to see that inflation really becoming a problem for people and driving those prices very high. And as we transition through this phase, as growth really takes hold in the economy, we start to see a new season come around. And this time, growth is still strong, but now we start to have issues of inflation. Now, this might sound very familiar to you guys watching because, hey, that's pretty much where we are at this phase, where we have been over the last several years. Growth has been really strong, but we've also had really high inflation. Eventually, we start to get to the top of the markets. Not necessarily how the stock markets are priced, but the economy simply can't push out any more production than it has so far. And we move into what we call a slowdown, or the peak of the economy. Now growth starts to slow down. And we still may have really high inflation because, hey, prices are still really high. People were paying a lot for things and companies had no real problems making those sales. But eventually those high costs start to have an impact on growth on companies. People stop buying things as much as they used to, which means growth starts to slow down. And that peak at the top of the economy is what starts to send the economy into the next phase, which is the contractionary period. Or in other words, sometimes this is called a recession, depending on what's going on in the economy. This is when, hey, growth has been falling for a while. And in fact, growth has fallen so much that maybe the Fed has started to reduce interest rates. Maybe inflation is not so much of a problem anymore. People aren't spending as much anymore. So companies have to possibly stop price increases. And at some point, we finally start to see consumers become more comfortable with spending again, and thus growth begins to increase once again. Of course, inflation is still low at that point, and you can see how this has a very circular process in how the economy works. And so it's quite clear that we have been in an expansionary period for quite some time, and it looks like we may be heading into a slowdown period. But this is what these guys are trying to figure out. They believe that this slowdown is coming, and if so, growth is going to fall, and therefore bonds are likely to be a better asset class for portfolios. Why take the additional risk of equities or stocks if the growth is not going to be there? The only reason we take risk is for that opportunity of growth. So now you're starting to see the idea or the thought process behind this report. So I want you to think about the economy no longer using rocket fuel per se, and just switching to something like good old standard 87 octane. Okay, so now that you understand what's going on, what do you do about this? What does this mean for you as a retiring federal employee thinking about your financial future? How do you take this information and turn it into action items for your own plan? It can be tempting to say, you know what? Those guys know more than I do, and so I'm just going to do what they are doing. But overall, I would caution federal employees away from doing something like that. Let's take a look at a real retirement plan example that shows you what can the potential impact of taking an approach like this truly be in the long term. So here we've got Mr. and Mrs. Sample back again to help us with one of our examples. And if you guys haven't seen this before, what we did here is we basically replicated a real client situation in our system, redacted their personal information, so obviously we could protect their data. So what we've got here, a couple, they've got a couple of kids. Kids are a little bit older. One works at OMB, the other's a researcher at Hopkins. So pretty average family, very similar to a lot of our firm's clients. When we look at their total net worth, they've got a variety of different accounts. We've got a 401k in there, a TSP. They've got a small Roth and a home here in the DC area that is just shy of $1 million, which might sound like a lot for a lot of folks depending on where you are in the country. Around here in the DC area, that's really just an average home. And they have a mortgage of about $400,000 left. When it comes to their income, both of them are still working, although they're going to retire here very, very soon, as you'll soon see. And we've got Social Security income for both of them, as well as his FERS annuity pension that's been programmed in there. And then, of course, with a COLA after turning 62 and a supplement until then. When we look at their expenses, they spend about $8,000 a month or so. Of course, they've got that mortgage in there. So let's jump into the system and look at their plan together. So when we first look at the projection, things look really good for this family. Okay, they're retiring in a couple of years here. Looks like both of them at the same time. Their pension is going to start. They're drawing from their portfolio, obviously because they don't have Social Security quite yet, so they are drawing from their assets. So this couple actually was interested in doing some extra travel for the first 10 years of retirement. They had a home renovation they wanted to do a little bit later on. There's a car purchase that I didn't mention from earlier. So we turned these expenses on and hey, everything still looks really good here. Okay, they're 95% probability of success in a Monte Carlo analysis, which is one of the tools that we use as financial planners. So very, very strong situation, including if we create a long-term care event in here. Okay, so remember, long-term care, folks, is a really big concern for retirees later in life. So here we've got those expenses in their 80s. And even then, we're talking over 80% probability of success. So in all circumstances, it does look like things look pretty good while we're using average portfolio returns. Now, the reason we use average returns, nobody actually gets average returns year to year, but this is to understand their trajectory over time. Truth is, you're gonna get either a lot better than average or a lot worse than average. That's how you get an average. And so there's some other risks in here that we're not factoring, but just looking at this as an example, okay? Now, let's turn these back off. We'll take them back to their original as-is plan. And now let's look at the growth rates changing, because reallocating to a 30% stock and 70% bond portfolio, and let's just say that you do that for the entirety of your retirement plan, because again, the older you get, you need to stay conservative. What kind of impact does this have on the plan? Well, at first glance, that's a lot of potential gain that they are no longer participating in long term. Okay, so we see a reduction in values as time goes on, as they continue to have to spend more to keep up their lifestyle with inflation. Now, still, even if they have a more conservative portfolio, it doesn't look like we have any funding problems here as time goes on. When we look at cash flow and expenses, again, looks like all their needs are being met, still with high probability of success. The problem is, now, what happened to the rest of their goals? If we start to add that travel and that home renovation, does the picture still look okay? Well, not so much anymore. We start to have some issues, especially if we factor in a health event that's a long-term care. When we look at probabilities of success at this point, now we're down into the 30s, which is a really big problem. And this is a result of just not outpacing inflation and the cost of living and replacing the spending. If you're going to maintain a portfolio that is historically, we used average returns for a 30-70 portfolio here. And so the lesson here is that while Vanguard may be recommending this for certain retirement accounts and for certain periods of time, you really have to be careful in how you're going to use this in your own retirement plan, because this can have a longer term impact. And remember, we haven't even mentioned taxes or other variables that could come into play as well. One really important detail about this guidance from Vanguard is that they're not saying for you to use this into perpetuity for the remainder of your retirement plan. There is a time and place for a specific portfolio strategy, and that's the key lesson here. There's a lot that needs to be said about what you're going to do for the early stages of retirement. And in shorter time frames like this, we have to be really careful with market volatility and not take more risk than is necessary to meet the cash flow requirements that you need to retire. You don't have a lot of time to recover if the markets go south. There's really interesting research that suggests that the pain of loss is 2.5 times worse than the pleasure of gain. Sounds crazy, right? But imagine this. You're walking to a grocery store, and on your way from the parking lot inside to the store, you find 2 $100 bills on the floors. But as you were walking through the store, you accidentally dropped one of those $100 bills. So when you got home, you realized one of them was lost and you only had 100 left. Now imagine a different scenario where instead of finding 2 $100 bills, you only found one and you never lost it. Which scenario feels worse to you? The one where you lost the $100 bill, right? In both scenarios, your end result is exactly the same. You're $100 richer than the day before. But somehow starting with 200 and then losing 100 of that feels way worse. Vanguard knows this, and when looking at a 10-year time horizon, portfolio losses can be very difficult, both financially and emotionally. As a federal retiree, you have multiple time horizons, not just the next 10 years. If you're retiring now, you might need some money from your portfolio rather soon, so your time horizon could be something like 0 to 36 months, for instance. But you also plan to be retired for a while, so 5 years from now, you're gonna have needs as well. Maybe it's when you decide you're gonna move into your retirement home because now the kids are out of college and often doing their own thing. How about 10 years from now? Yep, you're probably still going to want to be traveling then and getting out there and doing the fun stuff in retirement because you're still in those go-go years, which is the early phase of retirement. Things are going to be more expensive there, so you might want to start incorporating stocks for that kind of time horizon. Stocks are going to be able to help keep up with that rising cost and replace some of the spending you've done over time. But then what about 15 to 20 years or beyond that, when you are into your 80s and hopefully your 90s. Your needs are going to be totally different there. That is the no-go phase, as we call it. You might have much higher healthcare expenses than you have in other areas of your life. And remember, healthcare inflation is almost twice the amount of regular inflation. And so suddenly you recognize that a real retirement plan has many more complexities and variables than just looking at the markets for over the next 10 years. Retirement planning is all about reducing the risks that can take your retirement and turn it into a future that you really didn't want. You can't be too conservative or risk not being able to maintain your lifestyle for as long as you want. You can't be too aggressive or risk volatility and sequence of returns, creating an earlier end to your retirement plan. So it's certainly clear that the markets and economy are transitioning, and you have to look at reducing those potential risks both now and in the future. And if you want to learn more about investing in retirement as a federal employee, then check out this video here on the screen. Make sure you're subscribed to the channel if you haven't done that yet. And until next time, stay wise and stay wealthy.